I want to be blunt. Wealth isn't built by hoping for the next big break, you know. It's built through relentless, reproducible actions you repeat until they compound into results. Today I'm going to hand you 10 specific money moves. Not theory, not feel-good platitudes, but practical, executable steps that actually move the needle. Most people act like money management is a personality trait. Either you have it, or you don't. That's false. It's a set of behaviors you can learn, automate, scale. Over the next 20 minutes I'll show you how to construct financial systems that require less willpower and more structure, so you can focus on value creation. If you follow these moves in order, and actually do them, you will change your financial trajectory. I don't care where you start, broke, comfortable, or already wealthy. This is about leverage, risk management, and creating optionality so your future isn't dictated by surprise events or taxes. An emergency fund is not optional. It's a foundational risk management tool that gives you time to make rational decisions. Start by calculating your absolute monthly burn, rent, food, utilities, minimum debt payments, insurance. Multiply that by 3 to 6 months, make that your goal. If your income is variable, err towards 6 months. Treat contributions like a recurring expense. You wouldn't skip rent, so don't skip this. Keep this fund liquid and safe. High-yield savings account, short-term money market. Don't invest your emergency fund in volatile assets. Stability and access. When life throws a curveball, having cash lets you negotiate, pivot, take advantage of opportunities instead of panicking. Automation removes the human element of procrastination and temptation from financial progress. Set up your paycheck to split at the source. A percent to checking for bills, a percent to savings, a percent to investments. If your payroll system or bank doesn't allow that, create scheduled transfers on paydays. Make paying yourself first non-optional, the first transaction, not the leftover. Automate bills too, utilities, mortgage, subscriptions, insurance. Automate them to avoid late fees and headaches. Use a dedicated bill account to separate living cash from obligations. Automation reduces cognitive load and stops decisions from becoming excuses. For savings, automate multiple buckets: emergency fund, short-term goals, long-term investments. Give each bucket a name and a schedule. When income varies, use proportional automation. In high-income months, the system captures surplus. In lean months, contributions shrink, but the habit stays. Review automation quarterly to update targets and reallocate windfalls. The point isn't rigidity. It's the discipline of consistent action. Automation is the engine. Your job is to steer the car by adjusting allocations when circumstances change. Tax-advantaged accounts are an immediate return on your money because they reduce taxes today or in the future. That's free money relative to a taxable account. Maxing them out should be near the top of your priority list when you can afford it. For most people that means contributing to 401k, Roth IRA, traditional IRA, HSA, and any employer match. Employer matches are free money. Contribute at least enough to capture 100% of it. Beyond the match, prioritize based on tax strategy. Ratsasorat Bonpertram Sasam Andin 1. Tax 1, tax-free growth if you expect higher rates later. Traditional, tax deductions now if you need the break. Health savings accounts are often underutilized. Pre-tax contributions, tax-free growth, tax-free withdrawals for qualified medical expenses. If eligible, max the HSA. Use it strategically as an emergency supplement and as a retirement supplement for healthcare costs. If you're self-employed, use SEP IRA, Solo 401k, Simple IRA. The more you can shelter tax-inefficient income into these vehicles legally, the more capital you keep compounding. Think of taxes as a silent partner. Minimize their take legally and ethically. Finally, set up automatic contributions to these accounts and revisit allocations annually. Make it routine like brushing your teeth. Maximizing tax-advantaged accounts compounds over decades and creates optionality in retirement. Decisions shift from scarcity-driven to opportunity-driven. If you're not a professional stock picker, and most people aren't, your best odds of long-term market success are low-cost broad market index funds. They capture the economy's growth, compound returns, and avoid the drag of high fees. Low fees mean more of your money stays invested, not lining someone else's pockets. Consistency matters more than timing. Dollar cost averaging via automatic contributions smooths out volatility and forces discipline. Market dips feel scary, but missing gains by sitting on the sidelines is far more costly. Commit to a monthly amount and stick to it. No emotion, no headlines. Diversify across broad indices. Total stock market, international, bonds appropriate to your risk tolerance and life stage. Rebalance annually instead of overtrading. Rebalancing enforces buying low and selling high. Keep allocations simple. Complexity invites mistakes and paralysis. Avoid high turnover funds and exotic strategies you don't understand. The financial industry profits from complexity. Simplicity wins. Pair with tax-efficient placement. Hold tax-inefficient assets in tax-advantaged accounts and tax-efficient funds in taxable accounts. Low-cost indexing, consistency, tax awareness creates a low-effort, high-probability wealth-building engine. Relying on a single paycheck is a risk, not a strategy. Multiple income streams diversify your cash flow and create options. That can mean a side business, freelance services, passive investments, royalties, rental income, productized offerings. The goal is repeated, independent sources that allow you to survive shocks and invest aggressively. Start with one additional stream. Make it scalable. Don't spread yourself thin, double down on one idea until it produces predictable cash. Treat each stream as a product. Who is the customer? What problem do you solve? What is the unit economics? If the math doesn't work, iterate. Automate and systematize. For service businesses, create SOPs and templates. For digital products, focus on distribution that compounds, content, partnerships, platforms. Invest the profits back into scaling the highest return opportunities, not into nicer cars. Use a portion for investments, a portion for taxes, a portion for reinvestment, a portion for rewards. Finally, treat multiple incomes as insurance and leverage. When one stream slows, others keep you afloat and give you the capital to experiment. The ability to take risks, because the downside is limited. That's the real advantage. High-interest debt is a tax on your future self. The interest rate is a guaranteed negative return that erodes wealth. Prioritize paying off any debt with rates materially above what you can reliably earn investing. Credit cards, high-rate personal loans, payday loans. Use the avalanche method. Pay minimums everywhere. Shovel extra cash toward the highest rate debt. The math is simple. If you need psychological wins, combine with the snowball method. Eliminate small balances quickly. Apply that freed cash to larger debts. Refinance or consolidate where it makes sense. Move high-rate balances to lower-rate options if you qualify, but don't use it as an excuse to take on more debt. The goal is to reduce the total interest paid, not to create breathing room that encourages more spending. While paying down debt, maintain the emergency fund and automation rules. Don't blow up your safety net. Balance aggression with prudence. Eliminate the highest cost liabilities. Protect your runway and invest in tax-advantaged accounts. Once rates are manageable, redirect the cash flow you were using for debt service into investments and income-generating assets. The freedom from high-interest debt is transformative, increases cash flow, reduces stress, and unlocks capital for compounding. Taxes are the largest recurring expense most people have. Optimizing them is high leverage because reductions compound year after year. Start with the basics. Contribute to retirement accounts. Capture employer matches. Use HSAs. Understand which accounts are tax-deferred or tax-free. Those actions alone change your effective tax rate materially. Get organized for deductions and credits. Track business expenses, mileage, home office costs if legitimate, charitable donations, education credits where applicable. Use accounting software or simple spreadsheets. Documentation turns potential deductions into realized savings. If you own a business, structure it for tax efficiency. Choose the right entity. Understand allowable deductions. Use retirement options that reduce taxable income. Hire a competent CPA who understands your industry. The cost often pays for itself. Don't treat taxes as an afterthought. Consider tax loss harvesting. Use placement strategies in taxable accounts. Hold tax-inefficient assets in retirement accounts. Tax-efficient funds in brokerage. Use Roth conversions strategically. Pay the tax at low rates. Timing matters. Finally, don't be aggressive to the point of risk. Optimize within the law. Keep documentation. Get professional advice for complex moves. The objective is to minimize taxes legally, preserve capital, and redirect savings into high ROI activities that compound your wealth faster. Your earning potential is the single largest asset you own, and investing in yourself yields exponential returns. Learn skills that directly increase income or business outcomes: sales, negotiation, copywriting, operations, leadership. These skills transfer across industries and scale with experience. Allocate time and money to focused training, books, paid courses, high-quality mentorship, deliberate practice. Avoid scattershot learning. Pick a skill, set measurable goals, execute. Track outcomes from your learning investment, leads generated, sales closed, efficiency gains. If it doesn't move the needle, iterate. Network intentionally. Opportunities you see, partners you find, the speed at which you scale. Build relationships one level above you. Provide value first. Be consistent. Networking is compounding. Customers, capital, mentorship. Create systems for skill application. Dedicate weekly blocks to practice. Set accountability. Measure progress. Teach what you learn. Explaining accelerates mastery and increases visibility. Be patient. Skill compounding takes time but produces asymmetric ROI. Protect time for deep work and strategic relationships. Outsource low-value tasks. Leverage skills and network to create higher margin opportunities. Funnel extra cash into investments and business scaling. Equity ownership is where you capture disproportionate upside. Salaries pay for living. Equity creates wealth. Start a business. Solve a real customer problem. Scale margins. Invest in businesses that produce predictable cash flow and appreciation. Invest in real estate that produce predictable cash flow and appreciation. Equity adds optionality and control. Focus on unit economics. CAC versus LTV. Validate demand. Build repeatable systems. Measure conversion funnels. Make decisions off data. Use conservative underwriting. Insist on positive cash flow. Understand cap rates, vacancy risk, maintenance obligations. Leverage amplifies returns but also risk. Use discipline and a margin of safety. Consider passive equity approaches if you can't run a business. Be a limited partner. Invest via syndications. Buy shares in private deals. After due diligence. Diversify across multiple equity bets. Equity is not guaranteed. Treat it like deploying capital with variable outcomes. Owning equity aligns you with growth and transfers the value of leverage to you. What gets unmeasured gets managed. A written financial plan creates clarity, goals, timelines, monthly cash flow, savings rate, investment allocations, debt paydown schedules. Write it down in simple language and make it actionable with specific numbers. Review weekly, cash position, automated transfers, upcoming bills, progress toward goals. Use a single dashboard to track net worth, income streams, expenses. Small weekly adjustments compound. Rebalance and update projections monthly, quarterly. Diagnose misses. System, market, execution. Fix, change tactic or cut losses. Set leading indicators. Document lessons. Weekly reviews enforce accountability. You don't need perfect knowledge to start. You need consistent action. Implement the first 3 moves this week. Emergency fund. Automate savings. Capture any employer match. Those create the foundation. Commit, and then scale consistently from there.